Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are with us as we talk about financial matters, both myself and my co-host here, Pat. We are both financial advisors, certified financial planner, chartered financial consultants. That just means that we are experienced and educated in the realm of financial planning, and we are professionals, meaning that we've spent the last 3 decades in this industry working with people like yourself, and we're here broadcasting to be your financial advisors on the air or on podcast or...
Yeah, and when we speak of the podcast, I want to thank the listeners that listen to our podcast for rating our show. Our marketing people actually pointed out to us that we have almost a 5-star rating, and there's been almost 500 people that have...
We do have a 5-star rating.
Is it 5 stars?
Yes. It's amazing.
Well, it can't be perfect 5 stars. Not everyone can.
Rounded up. It must be 4.95 plus, I guess. It was 5.0 on Apple.
They can't. There's someone's gonna look. I've been around for 58 years.
Haven't you been an Uber driver when they've got a 5-star every once in a while?
Okay,
they exist.
All right. Well, anyway,
we are unicorns.
We thank you. We thank you for listening and sharing our show with others. Obviously, these are selfish intents here because the more people that listen to our show, the better it is for our show. And I think if you're listening at all...
But I don't think it's a review, not a rating, too.
Oh, okay.
Review.
It's a review. But if you listen to our show at all, we own an investment advisory firm. Scott and I are partners at Allworth Financial that we started 30 years ago. And we're practicing financial advisors. We manage over $11 billion for clients in multiple states. And the reason I'm saying that is we do have our own agenda. We would like people to actually use our firm at some point in time. But in saying that...
That's not the purpose of this program.
That's not the purpose of this program. And quite frankly, there are people that are so good at it, they don't need our help. And if you are one of those people... And you just
what percentage of the population is that, in your honest opinion?
Oh, that have investable assets? Well, what percentage of the population actually?
Do you not think that? What percentage of the population, Pat, that think that you believe would do better on their own than with your advice?
90%.
Need an advisor?
Yes. Yeah. 90%.
I was going to say 95%.
Yeah, 90%. At some point in time, either episodic or forever. Right? Episodic means something comes up and they just have a couple questions about how to manage that situation. So, as I was saying, the intent of our show is not to promote our firm, although if you'd love to use our firm, we'd love to talk to you. The intent of our show is to provide real-world financial advice with situations that are not academic in nature. They're not theoretical. Right. They're real. And the reason I can say that quite comfortably is Scott and I have worked with
thousands.
Personally, hundreds and hundreds of clients.
Yeah, all right, over the years.
But thousands as a firm over the years.
And we've had thousands of conversations. We've had 1,000 of these programs.
Yes. So anyway, we'd like you to join the show. If you'd like to join the show, it's 833-99-WORTH. That's 833-999-6784. Did you get that? Our marketing people figured out how to use Worth in our phone number so that you'd remember Allworth Financial. That is pretty smart.
And before we take some calls here, it is amazing how strong the stock market has been this year.
Unbelievable. Scary, unbelievable.
Then again, the economy is doing much better than people had anticipated.
So
we're broadcasting from lockdown California,
yes,
Sacramento, and just this week being on the road, I couldn't believe how much traffic there was. It was like back to normal, both on the freeway as well as driving through town.
Yes,
sometimes it takes you two green lights to get through the intersection because there's so many cars. It was felt like February of 2020.
Yeah, but so when you look at the economy. Right, and remember, the stock market isn't the economy. The economy is not the stock market. But the economy's on fire and the stock market is on fire. And I wonder, is it all the just really cheap money?
Well, that's what's driving up home prices.
It's driving home prices.
That's what's driving up. Well, when the bank pays you 0.01.
And what we're seeing is large Wall Street firms are buying blocks and blocks of homes. We haven't seen this at this level ever. But part of the reason is, remember, when you're buying a home, you're competing with a bunch of different parties. And you used to be competing against small people that would buy homes and turn them into rentals, or people that would occupy the homes or a second home. Now you're competing with large, where someone will go in and buy 200, 300, 400 homes, 2,000 homes.
Did you read about the one neighborhood that I forget what home builder was it? They built an entire neighborhood and sold it to one investor.
Actually, I know a guy that bought an entire neighborhood.
Okay. The entire neighborhood. And they said the margins, the home builder said the margins were about double what it would have been normally, the phenomenal margins.
For them, because they could sell them off in one block, so they didn't have the cost of distribution, and the person buying it can get really cheap financing on it. And the numbers work out. The numbers work out. And when they go to liquidate it, which they will, it'll be a lot easier to sell them 1, 2 at a time than a whole block.
Anyways,
it's amazing.
It's a time where everything is up in price.
But don't you worry about, like, when you see, like, Greensill Capital blows up, which is this,
that was amazing.
Debt financing. And then what was the other one? Arquat? What was the name of the other one that blew up?
The Tiger 2 guy. The hedge fund.
Yeah.
That was amazing.
Arcus, which was absolutely amazing. So
his personal net worth went from $8 billion to under $2 billion in a matter of a week.
But don't you worry about? So you're seeing little cracks here and there, right? I see those as little cracks. So those are risk cracks right there. That's what that was. Both of them. Greensill Capital was a risk crack, and Tiger 2 was a risk crack.
They were much more highly leveraged than anyone had any belief of, because they had multiple relationships with a variety of different financial firms using complex products.
So when I look at the market, you worry about these risk cracks there, and then you realize, is this exactly how the investing public is supposed to respond, which is low interest rates, lack of alternatives, drives you into riskier assets.
That's what the Fed's designed everything for.
Right? And that, therefore, spurs the economy. Just don't get over your skis here. Don't get too excited. Make sure you have a balanced portfolio. This too shall end.
And when things look scary, which they will again, don't react, assuming you've got the right kind of portfolio going in. This study that I just saw in the last couple of weeks, this was in Investment News, it showed that 401k savers, those that tinkered with their 401k last year, made changes, did not fare as well as those who didn't. And the report said that those people who self-directed their investment shifted to more conservative assets. This is right in the midst of the early on in the pandemic, with an average decrease in equities stocks by 17 percentage points.
Which is?
So they went from, let's say, 60% in stocks to 43% in stocks. And what this meant as far as the total return, they estimated, this is a Morningstar report, estimated underperformance by roughly 7.5%.
Which is massive.
Look, if you miss out on the good years, what are you going to do to make up for the bad years?
But Scott, they should have rebalanced their portfolio.
Yeah, buy.
But buy. So they should have picked
buy when things are cheap.
They should have picked a 60-40, 70-30, 80-20, 90-10, you name the number, and rebalanced up to that. Right now, if you were at 60-40 at the beginning of the pandemic, because that was what you determined your risk allocation should be, you should rebalance now, lowering your equity exposure. Lowering. And the reason people don't like to do that is because I hear them say all the time,
it's going so well.
It's doing so well. It's doing well. And you have to remember, the mere fact that we can measure it means it did well. Past tense. There's no present tense in the stock market. It's past tense. Every price that is ever quoted was the last trade. The last one.
That's right.
It just reminds me of someone showing me pictures of the kid, and they go, doesn't he look like he's getting older? And I'm like, well, by its very nature, every photograph you look at, you're going to be older. Because you're looking in the past, even if it was 10 minutes ago. That was my attempted humor.
Oh, I actually didn't even quite understand what you're talking about, but on the picture. Anyway, let's go to some calls because I know people would like to join us. 833-99-WORTH. Would love to take your financial question. Maybe someone's pitching you a product, wondering if you should make this investment. Just call us for a second opinion. Would love to help. Or if you're thinking if it's the right time for you to retire, or it's structured properly. 833-99-WORTH is the number. 833-99-WORTH. We're starting off with Chris. Chris, you're with Allworth Money Matters.
Hey, Scott, Pat, thanks for taking my call. Longtime listener, love the podcast format.
Thank you.
I think you should just make it a little longer. Instead of doing it for an hour, maybe make it an hour and a half or 2 hours. It gets me through all my weekly chores.
Well, Chris, if we could keep Scott Hansen's attention for more than an hour.
I had a long drive a week or two ago. I listened to Joe Rogan's podcast, the number one podcaster. They're like 3 hours. I'm like, who has time every week to listen to 3 hours? Anyway.
Well, but that's the beauty of a podcast. You just hit
That's
pause,
right.
and then when you have more time, you just go back and listen.
Yeah, but Chris, you're not doing the podcast. We are, and the longest we want to do is an hour.
Okay. I get it. Hey, I work for a living too. Hey, but so I think I have an easy question for you, but with a lot of complex probably solutions. So I am coming to an end of a CD ladder, and we had all these CD ladders started prior to COVID, and so obviously the interest rates were much higher than they are now. And so we had a couple already come due. It's sitting in cash, and we have another decent-sized one coming due the middle of May. And my question to you is what are you guys doing with cash these days? Because if you leave in the bank, and with the feeling that I have, I'm in industry, and I'm seeing what prices are doing on commodities, the stuff that we all use every day to build the products that everyone uses.
Inflation's coming.
I have a feeling inflation's coming. And so what are you guys recommending to your clients?
Of course, the challenge now,
what would you do with cash?
let's say inflation's running at 2%, which might be on the conservative side of things, but let's say it's 2%, and cash is earning, let's call it zero because it's so close to zero.
Pretty close to it.
So that means every year your accounts are dropping by 2 percentage points.
So
purchasing power.
It's an interesting conversation. I can share with the earlier in the week, Scott and I actually had this conversation on a Zoom meeting with each other about
it's a challenge
about alternatives to cash, and CDs are not attractive. You could take that money right now and you go to Ally Bank or Synchrony and you could get.
Well, let's define first of all, cash is money that you're going to need within 5 years.
Yeah, and so we kind of live fairly conservatively, but as far as cash as part of our overall portfolio, it's probably about 20%, maybe 25%. We're good savers. We've got a lot of money saved up in 401ks, IRAs, and brokerage accounts.
How old are you?
And this is 51 years old. My wife is 54.
And the kids' college, that's all funded, I assume?
Yeah, I have one left in the nest. She's getting ready to transfer off to four-year university. She's already done 2 years at junior college because of COVID and everything else. It just made more sense for her to stick around home.
So the challenge is anytime we move out of cash, we have to take on some element of risk or lock up our money for periods of time. But even if a 10-year treasury today is 1.7% ballpark.
Yeah, but so if you were looking at cash, you could go to one of the big online banks.
But if you're not going to be spending these dollars, my question is why not buy 5-year treasuries?
And that's what I'm kind of battling with, right? So essentially, it's just been money that we've just kept hoarding away and rolling over traditionally to CDs, and over the years it's gone down, up a little bit, down, and now it's just like nowhere. And I guess that's really the conversation I need to have. And I mean, I could dump it in the stock market, put it in dividend-paying stocks, so that at least you're getting paid to be patient, even if things drop.
Yeah, I wouldn't
if there was the right
that.
companies, right? You could, still get a yield on what you invested originally, potentially.
So,
Yeah,
to keep it in a very similar but not identical investment that treats it as close to cash as possible, you could go to one of the big online banks, Synchrony, Ally, Goldman Sachs has a new one called, starts with an M, and you could get 40 basis points or so, 0.4%, 0.3%, and the money's 100% liquid. Or you could go and put it in an ultra short-term bond fund, which invests in high-quality corporates,
maybe get
and treasuries.
percentage point.
0.6, 0.7, maybe, depending upon how long in the bond. But it's got buying a 5-year treasury and comparing it to a CD ladder, I don't think is a fair comparison. You mentioned a 5-year treasury.
Well, 20 to 25% is more cash than that's not invested.
That's a completely different conversation.
So part of the challenge, Chris, you're asking us to answer a question that we wouldn't pose for ourselves.
That's a complete, unless you actually think that you were going to be an opportunistic buyer in something with a portion of those cash, you have too much money in cash as a percentage of a portfolio.
We might be moving in a few years. We might want to buy.
That's kind of a mental thing, right? You got to get away from the fact that, because I mean, as we're sitting now, I mean, the amount of cash we have would probably sustain us easily for over 10 years.
Okay, well, that's too much cash.
No, and it has been, and there's been people that have told me over the years, you got to get off that entire mindset. But I felt comfortable with it when I was keeping up with inflation. But now the reality is setting in that
that's right.
My money's actually going to lose money, and now it's kind of getting me off the fence to think about alternatives like you mentioned. Yep. So a couple of things. I know you guys hate annuities for a variety of reasons. Mm-hmm. You guys aren't really big fans of life insurance as a hedge against taxes and that sort of thing. But at what point do you think that makes sense? Because obviously there's people that are still buying those. And at some point,
they're being sold those. They come with commissions, high commissions, so they're being sold those.
Sure.
So now, in all fairness, there are annuities out there, a small percentage of the population that may make sense. I wouldn't buy a fixed annuity in this environment, just flat out.
Because it's no different than buying a long-term bond in this environment.
That's right, and you don't need that. I don't think there would be a situation now with the pricing of annuities that I would buy a variable annuity. Life insurance, if you had a life insurance need and you were using it properly, which is you were funding up to the modified endowment contract limits, then perhaps if you went and bought a really inexpensive,
but if you're going to be in a variable life insurance, something you might as well just own a. Assuming you have the life insurance, if you need the life insurance for a long period of time.
But he doesn't need it.
No,
it would be strictly an investment. I mean,
well, then I wouldn't buy it for that.
Yeah.
I wouldn't buy it for that.
Because through work, we've got cheap term insurance, and when I'm done working, that assumes that my kids are gone and my wife will be taken care of whether I'm here or not.
So you are this is exactly why the Federal Reserve reduced interest rates. Whether or not they should have kept them this low this long, that's another question. Or even brought them this low. It's just the way, if you look at the way that the world kind of panicked with the early days of COVID and the lockdowns and stuff, the same thing essentially happened in both monetary and fiscal policy, right? All these spending bills that came out that really weren't that well thought out. We've got the Federal Reserve drops interest rates to zero, goes on this big buying spree in the marketplace, buying all kinds of bonds to push down longer-term interest rates. And it's causing investors like Chris, who normally would have been comfortable, at least my money's keeping pace with inflation, that's all I really care about, at least it's stored. Now you're starting to say, what the heck should I do here? Because the policies that the government has now put in place is causing me to go backwards every year on my cash investments.
But that won't be like that forever.
No, it won't be.
So you might have to take a hit for a year or two. So the answer to the question is ultra short term, low cost, ultra short term bond. Even a short term, it doesn't have to be ultra short.
That's a better cash alternative, I think.
Yeah,
for what you're trying to do.
Or go to one of the online banks, and you'll see no principal fluctuation in an online bank. With an ultra short or short term bond, there'll be a little bit, not a lot, but a little, and they invest in high quality corporates and U.S. governments, and that's where I'd go.
Like on the bond funds, though, now those will go inversely if they raise rates.
Yeah, but
right?
they're
if they're ultra short term, you get the ultra.
Yeah, so
ultra short
I was looking at one yesterday from a big fund company, and it had an average maturity of 13 months.
Okay, shoot. Okay,
And the yield on it was what was the yield on it? The yield on it was
I own
net
one
of
for
fees.
cash equivalent, but I don't remember what the yield is.
It was six. It was about
terrible.
0.6%.
It's terrible.
It was a
regardless
little
of
bit
what
better.
it is, yeah.
But I tell you, so Chris, just personally, I have done CD ladders, and then as they matured, I've gone into bond funds, short-term bond funds, and then a year later, I'll be back into CDs. It's just wherever the opportunity exists.
Yeah, and I think that's kind of what the conclusion I was coming to in my head as well. 'Cause it's just a weird environment. But like I said, I mean, from what I'm seeing with the stuff that I deal with on a daily basis, I mean, if inflation isn't coming, I mean, I don't know when it would.
Well, yeah, correct, right. That's why you want to own the thing
it's across the board.
Yeah.
It's not one commodity. I mean, it is everything right now.
Yep. And some of that, you wonder if it's supply chain or if it's
Well,
just
there's that. You shut down the supply market, the whole distribution chain.
Yeah, you wonder if it's supply chain or if it's cost of labor or a combination. It's probably a combination of multiple things. So anyway, remember the reason you've got as far as you've gotten with your money is because you were patient and persistent. You weren't stupid. You didn't do anything rash.
Yeah, don't do anything rash now, like buy an annuity that you can't get your money out for 10 years. We wish you well, Chris. Let's talk with Phil. Phil, you're with Allworth's Money Matters.
Good afternoon, guys. How are you?
Wonderful.
Good. Well, thanks for taking my question. I'm looking for a second opinion on a retirement decision I have to make, which is a full annuity versus reduced annuity and 25% in the form of a lump sum. And
You talk about this is for a lifetime pension that's giving you an option of taking a portion of the lump sum from your employer.
Yes, exactly.
Okay.
And is it only 25%? Is or do they have levels 50, 75, or 100%?
Yeah, it could be any of the above, but you want to take at least 25% in the form of an annuity to preserve your health insurance.
Okay,
got it.
that
Yep.
was it. Okay, thank you.
Yeah, right. So I want to know what your opinion is of the decision. Just a couple quick background facts before we talk about numbers. The reason I'm thinking of doing this is I don't have my primary mortgage paid off, and we have two houses and big mortgages on both of them. So I would feel comfortable if I had that 25% set aside. Kind of ties into the prior caller. I wouldn't worry about inflation. I'd put in something very safe, and I would sort of like stack that up against the mortgage on the primary residence and use that to pay it down.
So so you would take that, put it into a separate IRA, and have money come out of over a period of time to pay the mortgage down?
And I'm confused too. Is it 25% in pension and 75% in lump sum, or the other way around?
It's the other way around. It's 25% pension. 75% pension and 25% lump sum.
I mean, I don't have any real problem with that strategy, provided that the plan wasn't to take the money out all at once, because it'll be treated as taxable income in 1 year and push you into higher tax rates. You'll end up paying more in taxes than you would if it was distributed over a number of years.
So what is the lump sum?
The lump sum, and we need to qualify it because there's an IRS limitation that's affecting it.
415.
The lump sum is $726,500.
Okay.
And without the lump, the monthly amount would be $15,600.
Okay.
The reduction, it drops it down to $11,700. So if I look at that kind of from the reverse point of view, purchasing an annuity, giving up $3,900 a month or $46,800 a year in exchange for a lump of $726,500. And apparently there's a rule of thumb out there, 16 should be around 16 times. It's a little bit under that. And it is quite a bit reduced by the 415B limitation. I believe it would be about $844,000 if it weren't for that cap.
And what do you owe on your mortgage?
Well,
between the two of them.
Yeah. Between the two of them, let me see here. $515 on one and $452 on the other.
Okay.
The bright side is both of those are under 40% LTV.
Got it. So $967.
It's just,
how old are you?
This lump sum doesn't seem like a net present value. It feels like I don't know. It feels like a cash balance plan or something. It doesn't seem like a good trade-off to me.
Well, do you say that because it seems like it should be higher?
Yes, relative to the. I mean, if you told me,
No, so, Scott, so it's a difference between the two. It's $4,000 a month. It's $3,900 a month. That's the difference between the two.
the $726,000, is that the full lump sum?
Yeah, it only represents 70. It only represents 25% of the pension.
Right.
That's why the numbers are there.
The 720. Oh, so okay.
Got it. So it's a
Never mind.
$3,900. It's $3,900
I was
a month.
confused there. I thought,
it's-
wait a minute, your option's $15,000 a month in pension or $725,000.
Yeah. So it's $3,900 a month, or $726 is what the hurdle rate needs to be. So
Yeah,
Phil, we're going to go to a break
because we have a hard break.
We have a hard break,
radio
but we
for
want to
news.
continue this conversation because you've got a couple really big decisions to go, and we've got and probably some of the biggest financial decisions you'll ever make in your lifetime. So we're gonna
stick around for more Allworth's Money Matters. We'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean.
We were talking with Phil, and Phil is trying to figure out what to do with this pension. He has an option of taking a portion of a quite substantial pension, taking a portion of it in a lump sum, thinking about taking that portion, taking 25% of the lump sum, and using it to help pay down some mortgages on some homes.
So Phil,
Is that right, Phil?
Yeah, it is. And just to run the key numbers again, so we're clear.
Thank you.
The full annuity is $15,600 a month.
That's right.
The partial annuity is 75% annuity is $11,700 per month, and the lump is $726,500. And these are all 100% joint survivor numbers on the annuity.
And what's the dollar amount over the 726 that is the 415 limits?
You know, the closest I can get to that is the analyst was telling me that without the limitation, it would be $845,000.
Okay, so that's the number we're going to actually use, and the reason is, when you're determining whether to take a lump sum or a pension, you actually calculate what we call a hurdle rate, which is what kind of rate of return do I need on that money in order to provide that same amount of pension. When you look at this lump sum, you have to keep the 845. Some of it's going to obviously 119,000 is going to come to you as taxable income immediately, and 726 is going to be rolled over into an IRA.
I'm sorry. I'm sorry. I don't think that's right. The issue is $844,845. That's what it would be if they used the rate structure they would use for people in a lower income category, right? They're using a rate structure of 5.5, 5.5, and 5.5, and that is required by the IRS.
Got it.
Okay, got it. Okay, so your internal rate of return is about 5.5%.
The hurdle rate.
Assuming
you maintain your principal.
And do you have a normal life expectancy?
Yes, I would say so.
And is this a joint and survivor?
Yes.
Yes.
And your spouse has a normal life expectancy?
I believe so.
Okay.
Yeah.
What are the mortgage balances?
Between the two, 967.
How old are you?
65.
Are you going to go back to work?
No.
I like the concept. I'd actually like your concept. Let's take 25% of lump sum. Let's put it in an account. Let's invest it pretty conservatively. Let's have the mortgage payment come out of that. Maybe it'll pay for it for the next 15, 20 years. Worry about whatever balance is left on the homes
and how
way
much,
down the road.
How much money do you have outside of this amount in either your 457 or 401k? I'm guessing it's probably a 457.
Well, 457s, 401ks, both myself and my wife, about $3.6 million.
Oh, perfect. Great idea. Take it 25%.
I don't.
What?
Is there any cost of living on this pension?
Well, it's a funny formula. It's basically
You work for a university?
No, actually, I actually live in Davis, but it's not a university.
Oh,
plan.
okay. Yeah.
It has every year after 65, you get a 1% single payment. So 65, 1%, 66.
Every year?
2%. Yeah, it doesn't compound or anything. It's just a simple 1%, 2%, 3%,
it's simple.
so on and so forth. Yeah,
so they
and there's
just-
also, I should tell you, there's one more wrinkle, which is there is a beneficiary benefit. You know, in the worst case where, we both went down in a plane, the survivor, the beneficiaries would get, it's a little complicated. For the first 120 months, there's this benefit, and you say after 5 years, after 60 months, if we both passed, they would get a lump sum representing the present value of the remaining 60 months of payments. If that makes sense.
Got it. So it's got a 10
It's
year.
not either way. It's not going to.
It's got a 10-year certain on it. So, by the way, this is one of the nicest pensions, and I've been doing this for about 30 years. This is a nice pension, just the way they give you the options. The dollar amount, I have no idea what your income is, so I don't know whether it's good relative to your income or not. But the options that they give you, I would take the 25% rollover. I would take the 25% rollover at 5.5.
I mean, it's a roughly, think about the pension's worth about $3 million, right? 726 times 4, but worth about $3 million, and you got 3.6 in savings. So if you're taking, instead of having that entire $3 million, which should be 6% or so of your overall savings, you're taking 2.25. So you're reducing the percentage of essentially your retirement savings that's going to buy an immediate annuity. Which,
yes, and 100% comfortable in the 25%.
Yeah, I am too.
And
I can make arguments both ways.
I've got a couple more questions. You're Social Security eligible, correct?
Will be soon.
You want to take it as soon as you possibly can. You and your spouse. If they're going to cut back Social Security benefits, Phil, there's a picture of you in Congress, and they're looking at you.
What about the strategy of turning on the lower earner as soon as
Maybe.
eligibility?
I would run the numbers. I'd run the numbers
the other one
first.
till 70.
Oh, I wouldn't do that.
I'd run the numbers. It depends what
I think there's too much legislative risk, Scott. I mean, look at
the year 2030. The trust funds.
His pension's going to be, right.
You're an easy target. This is a pension. We're not talking about, you have a pension over $100,000 a year.
And then you've got IRAs at over investable assets of over $4 million. Between your IRAs.
Just the minimum distribution at age 70 is going to be $150,000, $160,000,
which isn't 72, which isn't
72.
far away. So I would
do the same.
I'd
run the numbers first.
You could do the math and run the numbers. The risk that you should worry about is legislative risk. Not you're going to miss something. It's that they're going to take something away from you. Because
that's why I need to find a financial planner and start working on Roth conversions.
Well, that's actually so. We actually just did a factoid that we're going to run in a couple of weeks, and we talk about the golden window between the ages of your retirement over age 59 and a half and 72.
Which, by the way, doing those Roth conversions, that throws another wrench into your Social Security equation. So, I mean, the way you need to plan this is you run multiple scenarios, look at the probabilities for each, and then make the best informed decision possible.
And I assume you've refinanced your mortgages into these low interest rates.
Yeah, they're pretty low, although I was a little slow because of being real busy with work and things like that. And also, I really like my servicer, which might sound crazy, but they're pretty decent. I think
that does sound crazy.
Said no one ever.
Send him a thank you note. It's going to be the first ever received.
I know.
Maybe.
I like my mortgage servicer.
Well, I've had some bad experiences in the past.
Oh, yes.
So.
Haven't we all?
Yeah.
But obviously, it would make sense for you to sit down with a qualified advisor and actually do the Social Security planning and the Roth conversion planning at exactly the same time.
Yes, absolutely.
Right.
All right. Well, thanks for your help. I appreciate it.
Yeah, wish you well.
Congrats. You've done well.
Yep, for sure. Let's talk now with Kurt. Kurt, you're with Allworth's Money Matters.
Hi, how you guys doing?
Wonderful, Kurt.
Good. Hey, I was calling just because I had some questions about Roth conversion. I'm kind of in a higher tax bracket the last few years and have been resistant to biting the bullet and converting some. I have currently most of my retirement money in tax-deferred accounts.
How old are you?
I'm 57 and thinking about possibly retiring in 3 to 4 years, and my wife is a year older, but she probably will work another 3 to 4 years beyond that.
And what's your current income, approximately family income?
Approximately $500,000.
And what's the amount in your qualified plans, IRAs, 401ks, 403bs?
$1.8 million approximately.
Okay. And
I do have a current Roth conversion I did a few years ago that, or between the two of us, it's about $265,000.
And why?
Why do I want to do a Roth? Or
why did you do it, and why are you considering it today?
I'm considering it now just because I'm trying to lower my taxes later, I guess, or get it done now when I've got some concerns that potentially the taxes will be going up.
What state do you live in?
I live in the San Francisco Bay Area.
And do you plan on living in California forever?
Probably so.
Okay.
Not really sure, but
I personally would not be inclined to do any Roth conversions at that income level.
I can't. You're
already pushing. You're not quite at the max for California, but dang close. You're not quite at the max for federal government.
And
but
you're going to retire.
Right.
You're going to your family income's $500,000, and you talked about retiring in 3 to 4 years, and then your wife after that. That is the time that you would actually start considering the Roth conversion. So, did someone give you advice to do the Roth conversion before?
No.
Okay.
What I've been doing is kind of holding off, like you're saying, thinking my window would be when I retired and before she did. But I also know that our income then, I approximate, I think it'll be somewhere between $250 and $300 then. So it won't be. It'll be lower, but it's not going to be like really low.
Oh, but
where's the income going to when you both retire? Do you have other forms of income other than work?
My wife will have a pension that'll pay about $7,500 a month.
Oh.
Okay.
And then just money from investments and taxable accounts and that kind of thing.
You can look when and of this $500,000 in income, what percentage is yours and what percentage is your wife?
I would say that 75%, 60 to 75% is mine.
Okay, so 300.
But here, the tax rate's very progressive. It's graduated, right? So if your income's almost nothing, you pay no income taxes. Half of Americans pay zero federal income taxes because of the way the tax structures work. But as you start making more, the tax rate, currently the top rate's 36%. But taxable income for married couples between $170,000 and $325,000 is at 24%. From $325,000 to $400,000's at 32%. Then it goes up from there. So there's a high probability you're going to be right now you're in a higher tax rate. There's a high probability that you're going to be in a lower tax bracket when you quit working. Right. So that would be the year.
But also they're talking about, nobody knows, I realize.
It's going to go up.
Yeah.
The question is, how much is it going to go up? And so
and there's no guarantee that Roths are going to be free of any sort of other taxation.
Or what happens if they add a VAT tax and it totally throws all our tax planning?
There used to be excise taxes on large 401k.
But the reality is, let's say even if tax rates went up by 5% for you, you're still at this income level driving yourself up into you're paying at the highest marginal tax rate, where if you wait until you could do the planning when you retire and your wife continues to work, that would be the first window. And then the second window is when you both stop. Between those ages and age 72, when the required minimum distribution takes place, is when you would actually, and as our last caller, you would put Social Security planning in around that. But I could not make an argument for any reason in the world.
You're in a 35% federal tax bracket. And if your income was $300,000, you'd be in a 24% tax bracket.
So, unless you really like what the government's doing with your money.
No, I don't love it at all. But I've been just sort of worried as start hearing how everything seems to be going up, especially in California on those taxes. I just thought about.
But
should I be moving portions of it in?
We would not recommend it.
Half a million within the next 3 to 5 years over to that.
Kurt, you said it right.
Yep.
You used the word worry, which is an emotion.
Right.
Right? I have no emotional attachment to your money. You have an emotional attachment to your money. And you called us to say, what do you think?
It's all about probabilities of outcome.
And what we know is that your chances of actually ending up with more after-tax income, you're better to wait based upon all the known facts, including we could bake in our analysis, we could bake in a tax increase and still show you how much the tax increase would have to go up at what marginal rates in order for you.
What did you just close the thing?
But let's say taxes went up by 5%, you'd still be better off waiting.
Well, right now his tax rate's about 50% higher.
That's right.
Than it would be when you quit working.
Yes.
Let me ask you one thing that's related. So I hear you. That sort of confirms what I've been doing, and maybe I've been making the right decision. I just realized my wife has the option of, she has a 457 at work, and it's just been, I guess, deferred. But we just realized, we didn't know, but she has the Roth option, and we were just shifting it to Roth to kind of build that up. But you think that's even a mistake, huh?
I participate in a pre-tax 401k.
I would not do it.
Okay.
Look, you're living in. Do you have children?
Yes.
Okay.
2 daughters that are adults.
And do they have children?
No.
Okay. So let's say the grandchildren move to Austin, Texas, or Yuma, Arizona, or whatever, and all your grandkids are there. There's a chance that you would leave California to be close to your grandchildren.
Yeah.
Right? And what we know historically is the tax rates in Texas, Nevada, Washington, Florida, we could go on and on. I could name almost 48 states that have lower tax rates than California.
Right.
Right? So those things are going to happen. And we talk about probabilities of outcome. You should take advantage of every tax deduction you possibly can on it. Grow all your money as tax deferred as you possibly can at this time.
I would agree.
And you did that Roth IRA conversion? Yeah, well, that was enough. I mean,
if you had 18 million in your IRA, it might be different.
Right.
Yeah. You're way too young to have 18 million. It was at one point in time that
if they bought like Bitcoin.
Oh yeah. Or if you're Mitt Romney.
Mitt Romney had it in his Roth. Like 100 million.
Yeah.
Wow.
Anyway.
Well, private equity, there's a way they can.
Yeah. Anyway, but does that answer your questions?
Yeah, I think so. You've I guess you've confirmed that I've been doing it right, or I haven't been making a mistake. I just thought I'd been blowing it. So.
No. But you did convert some money to a Roth already.
Yeah, and it was at a fairly high rate. Okay. But it was a few years ago. Then I've been on pause. I just got to thinking I was making a mistake.
Yep. Don't do it anymore.
Okay.
Yeah, and when you get ready when you're getting closer to retirement, it may make sense for you to reach out to a qualified advisor to actually do some planning, especially when you go in to do the Roth conversions.
Because I do have the concerns, or I figured legacy, that would sure be nice to leave that Roth stuff to the girls later if.
Maybe,
I won't need
but
it, really.
odds are they're not going to have careers that are bringing in $500,000 a year when you pass away, which means they'd be in a lower tax bracket.
Which means that you want to pass those dollars in without the Roth. You want to do it unqualified.
Right, I got you. Okay.
Because they're in one of the things you look at when you do the planning is the beneficiary's marginal tax rates. And he can actually plan around that too. So let's say you have a daughter that's making $400,000 and a daughter that's making $50,000. You leave the qualified pre-tax dollars to the daughter that's making the the low amount, and the Roth money to the one that's making the high amount, and you adjust accordingly.
I see.
That's part of the financial planning process.
And you explain that really well to the beneficiary, so they're not frustrated.
Well, yes.
What the heck's
like,
going
why
on
did she get? Why is? And then all you have to tell them is, they've always been my favorite child.
Yeah, I appreciate the call, Kurt. They've always been my favorite.
Okay, guys. Thanks a lot. I appreciate it.
My favorite. Yeah, well, you're my favorite child. But you bring up a great point on it's really about whose tax return is it going to fall upon. And I remember years ago, I had some clients, they had about $1 million in their retirement account somewhere there. Maybe it was $1.5 million somewhere in there. Both getting older. And they had 2 children. Both were highly professional that had very high incomes. They were in a much higher tax bracket than this couple was. So while the Roth conversion would make no sense for them in and of itself, we're like, we need to take advantage of your lower tax rates today because this is going to be money that your kids are going to be
So you did it with the clients.
Oh, yeah.
That's good. That's good planning, Scott. We talked about children and explaining it to children. So we had a conversation. My wife and I did some estate planning recently. And so I have 4 children. They're all great kids. I'm sure
what are you going to say?
Yours are
Even
too.
if one was a punk right now. But you got to publicly come out and say, I don't really like that
but some have
middle one.
more education in finance than others, right? Doesn't
or
mean
more driven in certain areas.
Yeah,
They're all different, right?
But we're naming our trustees. Right now, you're the trustee on my estate, Scott. So if something happens to my wife and I think you've known that. But my kids are of age now where we're handing off the responsibility to the kids because one of them's got a degree in economics, the other one's in business degree, so they're moving along. So we're having the conversation like who should be the trustee. What a can of worms that opened up. Like, well, why did they get to be the trustee? I'm like, well, their background's a little bit more around numbers and this. And they're like, well, that doesn't sound fair. I'm like, it's not a matter of fairness because the trustee doesn't get to decide they get more just because.
No, maybe that's still an age thing where they don't quite understand that the trustees has a legal duty to put the interest of the beneficiaries above.
Yeah. So the end of the story is at the end of the discussion with about who our trustee is. Mr. Hanson, you're still my
still
trustee.
A trustee. Yeah. Well, you're the trustee as well. So of my estate, should I?
Which is important, by the way, if you're doing estate planning, is to spend some time actually talking about the responsibilities of the trustee and who it should be. And it doesn't have to be a family member.
No, but it's best, my opinion, it's best to have an individual, someone that you're close with. I dealt with just recently, in the last 2 weeks, conversation with somebody, inherited some money, this small little tax firm was listed at a trust division, was listed as the trustee, essentially indefinitely on this. And then this person was trying to figure out, how do I get the money back out of this? I don't want this with this trustee anymore.
And you have to petition the court.
Yes, that's exactly it. It became messy. Messy quick. All right, let's continue on here with calls. 833-99-WORTH. We're talking with Jack. Jack, you're with Allworth's Money Matters.
Hi, thanks for having me on today.
Yeah.
So my question is, I am graduating college debt-free. And I was wondering if I should live at home for a couple of years in order to save up to buy a house, or if I should rent right away after college.
So I'm going to ask a couple questions. Do you want to live at home?
Right.
I mean, I'm fine with it. So it wouldn't be the worst thing ever, but at the same time, I know I wouldn't be getting, the same freedom that it would be if I rent somewhere else.
And do your parents want you living at home?
Yeah, they've said that they're fine with it as well too, if I decide to.
I'm fine with lots of things my kids do. The question was, do they want you to?
How are they going to tell them that?
Yes.
I've told my kids.
Yeah, they said.
Do you want your kids living with you?
No, I've got 4 of them. I told 3 of them they can't. One of them they can.
Well, one's a girl, the other a boy.
I told my daughter she could live in all of them. We were at dinner one night. I said, "You boys don't."
Yeah, there's a double standard.
Don't come back, but my daughter could live there.
Look, from a financial standpoint, let's live at home forever.
But look,
I'm kind of saying that.
How old are you, Jack?
22.
Did you get a job yet?
Yes. So I'm gonna have one right after college.
And how much does this job pay?
So I don't know exactly yet because I haven't had that conversation, but I'm assuming it's going to be around $40,000 to $45,000 a year.
Do what makes your heart. You're 22. Really, in the scheme of
I wouldn't
life,
be in that much of a rush to buy a house.
I wouldn't be in a rush to buy a house. You don't actually know where you're going to end up. Your career can take you lots of places. You might go on and go to graduate school. If you want to live with some friends, move in with some friends. Enjoy life. You're 22.
I didn't move back. I was so broke when I moved to Sacramento 6 months after I graduated college. I was renting a bedroom, $300 a month. It's been a few years, so maybe it'd be the equivalent of $600 a month or something today. There were some months I didn't have the money to make the credit card. I mean, the rent, I used a cash advance on my credit card, but I was betting that the business I was building was going to turn into something. And that's the time of life to do those sort of things. I hate to say it.
The most important thing you should do is maximize your 401k, 403b as soon as you retire or as soon as you start your job. You should go 100% equities in it. Start saving money on the side. But if you think you're going to experience life better.
And look, at the financial aspect is one piece of life. Living on your own. Yeah. Have you been living at college? You've been living at home?
Yeah, I lived in the dorms for like the first year of college.
And then after the dorms, lived where?
At home, mostly due to COVID.
I mean, if you're asking me, like as a mid-50s guy, like what my opinion would be,
move out. If you're asking me as a financial advisor,
stay home
with your parents till you're 70.
Yeah. Okay.
Right?
Makes sense.
All right. Appreciate it. Hey, congratulations. I'm sorry. Are you going to be able to walk? Are you walking?
Yeah. We actually have a graduation this year, which is great.
Oh, wow.
Yeah.
It's a real one with people in the audience and everything.
Yeah. It's going to be outside and all that stuff.
Oh, well, yeah. Congratulations.
For having it.
Congratulations.
Thanks. Yeah.
Appreciate it.
Thank you.
All right.
Appreciate the call.
Thank you. I appreciate it.
My son is graduating from a UC school,
and
it doesn't look like they're going to be able to walk. Awful. It's just anyway.
But my 8th grader, you're like looking at Patty's line.
This poor kid. I mean, he's graduating with almost like he's worked so hard, and you're like And he's like, we're like, well, want to have a party? Well, I don't know, and we're like,
our ceremonies.
Anyway,
every society since the beginning of time have had celebrations, ceremonies, remembrances, banquets, all that stuff.
Yeah. So you're 8th grader?
They're doing a parade.
Okay.
Which I'm happy about because I don't have to sit out there and listen to someone jabber on for a while. I just got to drive the car.
Anyway, we're out of time. You can find us at allworthfinancial.com, allworthfinancial.com. And there was something we were supposed to talk about.
Anyway, we're out of time. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.